Welcome to the daily update, where I'll go over the action in the market for Thursday, September 19th, and then we'll see how things look for Friday, September 20th. Man, we had a pretty powerful update. Now, I had warned in the video for yesterday, and I warned in some of the videos that I post on the website, be careful about a gap higher and then a big sell-off after that. We've seen that before. I've seen it many times over the years. Didn't happen, okay? But at least we were not caught off guard if it did. And those are the things that I tend to point out in these videos, things that may not happen, but when you get locked into one scenario only, then sometimes all of a sudden that switches on you and you're acting out of an emotional state rather than a logical state based on the data that we're seeing. And that's what I try to guard against, is we have to allow for three scenarios at the same time. The market can go up. What are we going to do? The market can go down. What are we going to do? The market is flat. What are we going to do? And we have to plan for all of those scenarios at the same time. We're still seeing some things that are giving us a little bit of a concern with our smart money indicators. They continue to decline, even though the market's going up. So we'll just go through and look at this. Now, another thing that's happening on Friday is that it's options expiration. And we went above 5,700 now with the S&P 500, and a whole lot of options that weren't worth anything, either calls or puts, are now suddenly worth something. And that could really change the dynamic, either positive or negative, but it could make it for kind of a crazy day. There are no economic reports coming out. So the market's just going to be left to deal with options expiration unless some kind of geopolitical thing comes flying in to really impact the markets. Okay, I have a thing called the SPXInvesting Program. I alluded to that just a second ago. There's a link that will take you to the website below this video. There's also a link that'll take you to a video that explains more about the program. Here's an email address if you want to contact me. One of the benefits is that you get early access to the videos. Now, it's free for right now. It's not always going to stay that way. But because of setting this all up and the logistics of being on a trip right now, I've delayed locking that down more. But feel free to check that out for right now and see if it's something that would benefit you. Also, this video that I'm doing right now, the daily video, it's the real foundation of the analysis that I do. And then over the weekend, I'll be preparing all of the weekly videos that are meant to tie into the daily video. All right, let's go back and talk about what happened and then go look at some charts. We had a huge gap higher open. We were up 1.75%, almost 2%. The futures were very strong. After the Fed cut rates and came out with their statement, there was the gyration that happens on Fed Day. Well, people slept on it, thought about it. Other world markets got a chance to react to it. And especially Europe was really strong. And that really helped the U.S. futures to gain some traction. And instead of selling into strength, we were able to hold on to those gains. But that produced a real gap higher open right at the open. We got above R2 at 57.16. And then we fell back below R2, but we didn't see any real significant selling before climbing back above R2. So that was kind of the key level in Thursday's session. Prices just kind of drifted a little bit. We held on to those gains and we closed at R2. We were up 1.7% on above average volume, and it's probably going to be above average for options expiration. Sometimes it's not, but usually that's a very heavy volume day. And we are positive in the short, intermediate, and long term. There's some concerns, and that's what I do. When we're really going up, I'm looking for things that say, okay, what can make us stop going up? Or if we're going down, I'm looking for things to say, okay, what's going to help us stop going down and maybe turn around and go back up? That's how I kind of mentally prepare for dealing with all three up, down, sideways strategies at the same time, is looking, okay, what can make this not continue? It's kind of like physics, you know, the Newton's laws, that something will stay going in the same direction unless it's acted upon by a force equal or greater to that particular motion. So that's kind of how I do things here. And it means that we have to look at extra charts. It means my videos are longer, but you end up getting a really good grasp on what's happening with the market. And inflation and interest rates, Well, it's more the fallout of interest rates right now because inflation seems to be under control. And the carryover from the Fed cutting rates on Wednesday is now really helping the market to look ahead at things being positive. But there's also some concerns that I'll go through, and then all the geopolitical things, but they just don't seem to have much of an impact right now. Some comments. Both the Dow and the S&P set new intraday all-time highs again. Now, this also led to closing highs for the Dow and S&P. And we're wondering about FOMO. That's an acronym for the fear of missing out. People, they went home on Wednesday that don't really follow the market all the time and said, oh, the Fed cut rates. I think I better buy me some stock. It's going up and I'm afraid of missing out on these gains. And that's what happens. You see people just piling in because they're afraid that they're going to lose out on some opportunities. And when that starts to develop, that means we're kind of late in the party. But we don't know that right now. We have a question mark after this. We're just wondering if that is one of the things that's happening with the market right now. And the ADX is still positive, and it's now crossing above its moving average. So we have a trend. It's just not confirmed. It's not confirmed until it crosses back above 20. I'll show you that chart. We do have a confirmed Hindenburg omen signal that was generated last week. That's still on the books. So we'll have to see if that leads to anything. And as you can imagine by the name, it's not positive. Now we have kind of a long list again with our short-term extreme positive indicators. The 20-period exponential moving average, that's based on the S&P, the Stochk RSI, Williams percent R, CCI 14 and 20. These are all on here after Thursday, as well as the boom indicator. We're getting kind of far away from the 20-period moving average. The only thing that was on the list from yesterday are the stochastics because they move a little bit slower. But now these are our usual charts that start to show that we're seeing good upside momentum, but at the same time, we're getting extreme with some of those readings. Intermediate term, the CMB composite, the 50-period exponential moving average means we're getting kind of far away from that 50 period, not only the 20, but the 50, because we really moved up. The Sean trend meter, which had been on the list, fell off. Now it's back on. The bullish percent index, and that's a bit of a concern. I consider that to be a primary indicator, and that's getting pretty high right now. And then, as I said, the boom indicator based on 50. And then the 150 and 200 days simple moving average. And then also the exponential moving average that we look at based on 200. So we're looking kind of extreme on all different time frames. This could be positive, but it could also mean we've gone up pretty far, pretty fast. And here is the scenario that we're going with for right now, that yes, the Fed came in and cut rates 0.5%, and it seems like the soft landing scenario is possible now, and that's what the market would really like. The dollar was down, but interest rates were up, and we closed at 3.73% with the 10-year yield. Didn't seem to have much of an impact on stocks, where it had been at 3.69% after Wednesday. We're still inverted with the 10 to the 3 month, and that's still going to take a while to work out, where the 10 to the 2 is back to being normal. Sentiment is positive. We went from 56 all the way up to 66. If we start inching up into that 70, 75 territory, that's when we start to look extreme positive from a sentiment standpoint. And we are positive with our trend. We are trending, but it's not confirmed because we haven't gone above 20. But we are above the moving average. And with the update, the bias is positive and the momentum is positive. We did get jobless claims came out weaker than expected. And the market kind of liked that. Now, the gains were already in there before the market even received this information. It's about an hour before the market opens. The futures were already strong, but this just kind of confirmed things after that. It shows that jobless claims are going down. They expected 232,000. We received 219,000. Last week, we had 231,000. The continuing claims are also dropping, and I have charts of both of these to show you. We came in at 1.829 million, and it was down from the 1.843 million. And then the second quarter current account balance, I don't have a chart of this one. It came in at a negative 266.8 billion. And even more negative than the 241 billion we saw last time. The Philadelphia Fed index came in at 1.7. They expected it to come in at 3. Last time it was down 7. Existing home sales, 3.86 million. That's a little bit less than the 3.9 million they thought were going to happen, and also down from the 3.96 million we saw last time. And then the leading economic index came in down 0.2%. They expected it to be down 0.3%, so a little better than expected. And last time, down 0.6%. And I do have a couple of charts to show you of that. So here are the jobless claims, where we're going down with the raw number, and we're also going down with the moving average. We're also rolling over with the continuing claims as well. So this is still suggesting that the employment situation is strong. And we did get the latest reading of unemployment back earlier in the month, but you can see where the continuing claims in blue and the initial claims in red are declining here. This is the LEI. It says it's continued to fall in 2024, but the rate of decline has moderated. So it's going down, but not down as much. And then this is one of the things that we were looking at to see, are we going to go into a recession or not? We're still down at this red line, which could still signal that we are in a recession, or could go into one, where we did drop well below that. But this time it didn't really mean anything. Well, we're still dancing right around this red line. Could that still indicate that we might go into a recession? Now, there's other charts that we look at that suggest we're not going to go into a recession. So we just take all of this together and reach our own conclusions based on the data that we have, not just basing it on an opinion that somebody else says. All right, and then here's some Isabel Net blog charts. It says the annual change in earnings is the best indicator, and that is. It's ultimately earnings. I mean, you can hype a stock up or down, but it's ultimately, are they making money? Are they growing? And if their earnings are growing, then their stock price is justified to be higher. And we just get a latest reading here on how this is looking. And this is a very long-term chart that you can look at just to see how they do really correlate with each other. There have been 26 US 10 to the 2 disinversions, okay, that I say uninverted, since 1950. And you can see that a lot of the times they went into a recession after that. And the economy will go into a recession at some point, whether it's going to be soon or down the road. That's the part we don't know. Based on Keynesian economics, that's how these kinds of economies work. When you have government, trying to control things to prevent a bubble to the upside or a real drop to the downside, well, they tend to overshoot things. But we haven't seen that yet. All right, and then this looks like a scan barcode or something that you would see when you look at something, except they don't have color on theirs. This is the occurrence of drawdowns within a 12-month window. That means declines. And the conclusion that they're reaching here is, you see all the orange area. This is the 20% drawdown. They're less frequent than what we saw in the 1990s. Now, you could say, well, that's great. We're not seeing the declines that we've seen before. But on the other hand, you could say, well, doesn't that mean we're due for one? Mm-hmm. Okay, and then this is the September's dot plot. And if you want to pause this and look at it, just go right ahead. But somehow they get information out of this to figure what kind of rate cuts they're looking at going forward from here. And then what's the most crowded trade? Folks are not in the Magnificent Seven as much. Now, the growth stocks did really well. They were really leading things higher. Not enough to really change things that much. They're still positive, but they're kind of losing their flair these days, where it had been the thing that people were getting into. And China's having some trouble now. So you got a lot of people that are shorting, which means they benefit if Chinese stocks go down. You've got people running into gold right now and more into bonds, and a lot less shorting the Japanese yen, as it's now in an uptrend compared to the dollar. And then the financial conditions are actually declining a little bit here, showing that we're in a little looser type of an environment. That can often be more beneficial for the stock market. And then the risk appetite indicator still dropping down below zero, but it could be starting to go back up if we see more advances going forward from here. And then new privately owned housing units authorized in permit issuing places, just coming up here, and you can see other times where we tend to top out and then come down and then go into a recession. Other times we start to decline while we're going into a recession. We're pretty much flat right now. And we've been seeing some real improvement in the housing market and real estate in general. And that has to do with this anticipation of interest rates going down. And I'm not going to read through all this. These are just where are people putting their money into utilities. A lot are going into the European stocks, banks, which are doing quite well, insurance, REITs, and people are taking money out of tech, energy, industrials, and materials, which have been doing a little bit better lately. So we'll have to see if this shifts going forward. Now, this is more on a global basis, not just US. I haven't spent really any time on Twitter. Maybe I should do that sometime. Here's our intraday chart here, where on Wednesday, you see this was the gyration that happened after the Fed announcement. And that's just a crazy day in and of itself. But then we gapped higher. We got up above R2, came back down below it. And then this is when, if the selling was going to come in, it probably would have happened about at this point. It didn't. Some buying came back in, pushed this back above R2, and then we drifted down lower and closed pretty much at R2. And we're pretty much flat right now with the futures in the initial overnight session. But you can see in this lighter blue area, this is where the futures really took off and really started to show some improvement, and that carried over into the cash session. And we're seeing an improvement here. This is kind of encouraging. The blue line and the red line are pretty much on top of each other, and they're both going up now. Where this had been a concern, we've been seeing the red line above the blue line. And you can see at other times when we've seen nice big upward moves in the market, the blue line is clearly above the red line, even though they're on different scales. And we're seeing an improvement here, but not a real breakout. Even though growth had a really good day, it's got some catching up to do here, where, again, you can go back to the middle to latter part of August. That's when we topped out, and this is when the market was under pressure. Then we started to go back up. This is when the S&P was bouncing back up. Well, we were flat here, and we did advance a little bit, but we're not really showing any upward move, at least yet. So end of day, growth was up a whopping 2.5%, with value being up 0.74%. They were pretty much even with the mid caps, and the small caps saw growth outperforming value there. And so we're seeing a little bit of a tick up, but not a major improvement with our small cap growth to value, mid cap growth to value, and S&P growth to value. We need to see more follow through with this, not just one day. And we're bouncing off of the 250 period moving average. When we look at the growth ETF versus the value ETF, we're coming back up into the rainbow, but we need to see more follow through on the upside with this as well. Large cap growth still doing well, not setting an all-time high yet the way the S&P did, but still above their moving averages. And discretionary to staples went up a little bit here, but again, we need to see more follow through from this than what we're seeing, but it's positive. We're starting to turn up with the ADX. It's going above the moving average. That means we're now trending, but it'll be confirmed when we get above 20. The green line's on top and advancing. The red line's going down, so we are positive here. Also turning up with our short-term chart, green line on top, still below 20. And we did pick up. We were slightly above average with the volume. So after the last few days being below volume, seeing a pickup was just showing more health in the market right now. And we're pretty much flat with the Ulster Index. When we look at sentiment, we did decline with the VIX, but not in a huge way, both with the bar line chart and the bar chart. Also, when the VIX goes down, the VIX of the VIX also goes down, and it declined. The momentum of the VIX continues to be down. Here's the seasonal chart that we're keeping an eye on because it has a tendency to go up, meaning the stocks are going down. We're still getting really high readings here with the skew index. So the market is still anticipating some kind of a big move. Is that going to be more to the upside? Is that going to be because of options expiration? Or is that going to be to the downside? We're not quite sure of the context, but something big is still potentially in the works as far as this chart is concerned. And we ticked down just a little bit with this fear gauge, and we went down quite a bit more here with this other fear gauge. Not the way you would necessarily expect it. We didn't see declines in fear like you would think we would. And that's evidenced by the equity put call ratio going up Folks are hedging their positions. And we're starting to turn back up with our 5-day after getting down to this extreme reading, bouncing back up. That's more negative. But when we look here, this is a longer term chart. And you can see when we get down to this level, and sometimes we can drop below it, and we may still do that at some point. But when this gets down here, that's when we look for more potential problems coming into the market. But we're still declining with our 10-day chart. It takes a longer term for that to shift. We did get the latest reading of the American Association of Individual Investors, and they're more positive, but not extreme positive. We'll have to see a week from now if we end up having a solid Friday, if they're getting a little bit too positive on things. And we're going back up with our risk on, risk off ratio. It was up 1.5% here, showing that folks are piling into stocks, which is not all that surprising based on how we were going up. We declined a little bit, but we're still in the band here with our volatility risk premium. So we're not seeing any kind of an extreme reading right now. We went up based on price with the advanced decline line. That's looking good, setting a high here. We also went up based on volume. So that's looking good. And we did see an expansion of the new highs, but we're not really busting out necessarily. However, our 5-day and 10-day are now starting to turn back up. So this internal measure is still looking pretty positive. And this is a little bit of a concern here, okay? The boom indicator just seems to be a little confused right now, but look how we're coming down and we're flat. Now, on a big update like we saw, we would expect accumulation distribution to really have a strong upward move. It didn't. Don't want to read too much into that, though. So on the positive side, we're still above an advancing moving average. So this is still looking pretty good. And we're going up, but not really busting out with the advanced decline ratio. This is one of the concerns. This is a smart money indicator. This tries to tell us, what are the big institutions doing? What are the folks that really control the market? What are they doing? We've been declining here with the Chaikin money flow. Now, it's still positive, but declining on a huge update like we saw, that's a concern. We're also declining with the Chaikin oscillator, another smart money indicator. And here is the advanced decline ratio, showing how we're going up in positive based on price and volume. And the vortex, an update like we saw, and the green line's going down. Okay, a little bit of a concern there. You would expect to have seen, more of an upward move with this indicator. We did see a real drop off with the selling, though, with the red line. And we're going up and setting a new all-time high here with the S&P cumulative measurement based on price and also based on volume. So that's looking pretty good. And when we compare the S&P to the NYSE advanced decline line, also, they tend to be moving together right now, both going up. The new highs, new lows, the daily score is positive, and then broken out down below here is the 50-day moving average. That's going up again. That's more intermediate term positive. And then we look at the NYSE cumulative advanced decline line based on price, setting a high here, breaking out with one of our NYSE advanced decline lines here, and also seeing that confirmed with this slightly different NYSE advanced decline line. Looking good there. When we look at it based on common stock, setting a new high based on price and volume. And we look at the new highs minus the new lows, a very positive number right now. And then we take a 50-period moving average of that as well, and that continues to go up. So we're looking good on all these measures here. Then we look at a broad market measure of the 5-period moving average of the highs minus the lows, looking really good right now. And we're actually going down a little bit with our large cap versus small cap ratio. Small caps had a pretty good day. And even the large caps had a good day too. Small caps did a little bit better. So we're looking good here with the advanced decline line studies, with the NYSE common stock, the S&P, the mid caps, and the small caps, all doing quite well. And even the small caps are breaking out above this previous range, as are the other indexes. So here is our chart. Not really much to see here other than if we keep going up, we do have some longer term overhead resistance. We're well above the 50-day moving average, and we did finally go up above the moving average when it applies to volume. But we're getting a little bit extreme here with the 20-period, 50-period, and 200-period exponential moving averages of the S&P. We're extreme with the Stochk RSI, Williams Percent R, CCI 14, and 20. These are our short-term indicators, and they go extreme quite easily. The stochastics in the short term, and I say this because this chart is a further subdivision of the short-term time frame. So the shortest of the short term is extreme. We're extreme in the intermediate term. We're also extreme in the long short term. And we're not extreme here, but looking more positive with the force index. The condition of the 20-period moving average, looking good right now, above both lines, and both lines are going up. We're above both the simple and exponential moving averages. And this could be more positive in that the blue line is now starting to cross above the red line, and it moves faster. So that means that there's more strength behind the upward move. We're above all the plotted moving averages here, and we're getting a little far away from the 20-period moving average. This measures the distance from price to the moving average, and we're getting extreme with the 20, 50, but we're not getting extreme with the 200 yet. But the 200 is still looking positive. We're up into the +2 channel here. We're not extreme here with the standard deviations. It's when we get up into the +3 channel, that's when we're getting extreme. We're going up with the stocks above their 20-period moving averages and positive. We're looking good. We're above 70 here. That could suggest good short-term momentum. We're going up with the 50-period moving average study, almost getting extreme with the 100, and going up with the 200-period moving average study. Balance of power above zero and going up. That's positive. And after just barely not being extreme positive, now the CMB composite is extreme again here. And here's the condition of the 50-period moving average above both lines. If the red line crosses above the blue line, that would suggest the intermediate term trend is more positive. We're looking good here with the go, no go, with the blue bars. We're starting to turn up with the highest high part of this chart. That's more positive as well. But we're not really seeing any movement here with the TTM squeeze. It's just been like on vacation and flatlining here. It's just not really giving us anything right now. And the standard deviation is going up because we've been going up pretty fast here. This measures speed, or not necessarily direction, just how fast something is going. And we finally switched over to positive here with the ease of movement. It had been improving, but now it's finally crossed back above zero. Now, this is interesting. We're seeing a real drop-off with the Erin indicator. Now, this is picking up a lot of selling, even though we had that really solid up day. It's also picking up a lot of buying, but when it compares the green line with the red line, this really dropped off. Now, it's still positive. It's no longer extreme, and we're above zero, but this, we'll just kind of make note of this for right now. And we're going up and looking positive with the S&P McClellan oscillator. So we're going up based on price and volume. Not really seeing much of a rollover, at least yet. We're going up with the NYSE McClellan oscillator and going up with the summation index based on price and volume. Now, this is another little bit of a concern, rolling over a bit here with the Swenlin trading oscillator. To be up 1.7% and to have this flatten out, a little bit of a concern. And to decline based on volume, another bit of a concern there. But momentum, looking good. PMO is positive. We're positive based on price and volume. We're going up with the PMOs that are rising. The buy signals are advancing, and we're going up with the PMOs above zero. Here's another momentum oscillator. Slope, that's our shorter term one, crossing above its moving average and crossing above the midpoint. The MACD is also looking positive. So we're looking good in the short term, intermediate term, starting to turn back up here in the long term. And we're turning positive with the Copic curve, another momentum oscillator. We've gone from neutral back to positive with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR. We're starting to get really extreme here with the Sean Trend meter. And this is the bullish percent index, where it went up, as you would expect, not a real breakout of the bar here, but we're up in this area where sometimes that means we're getting a little exhausted. We're going up with the NYSE bullish percent index, and we're also going up and just underneath the 70 level. If we go above that, that means the NASDAQ 100 is looking extreme, according to the bullish percent index. Going up in positive with the money flow, ticking back up with the ultimate oscillator above the moving average with on-balance volume, going back up with the RSI 9 and the RSI 14. This is a concern, and I haven't been showing this chart in a while. This is an Ichimoku cloud, which I often call an itchy and scratchy cloud. And you can see when sometimes the cloud will be used as support when we're going up and then we fall back. When we were going down in 2022, it may act as resistance. And in a good positive environment, the blue line's above the red line. Well, look what's happening here. we're seeing the red line crossing back above the blue line. That's a surprise. You wouldn't necessarily think that would be happening. So we want to be aware of that. This other green line, which is a little easier to see, it's still going up. But this is why I wanted to show this chart, is because we're seeing a cross here when really the blue line should just be taken off and going to the upside there. All right, we're looking good here with our weekly chart of the S&P. We're well above this R2 level. And we're looking good on a trending basis with the Heiken Ashi looking positive, the Kegi is positive, the Renko is positive, and the 3-line break is positive. We added another X with the point and figure chart here. And this is now giving us a signal of a double top breakout. Actually, you could almost say it was a triple. Well, I guess it's only double. We're breaking out the third time here. All right, then long term, we're going up. This also can mean good, solid momentum with the 150 and 200 period moving average, but we're above these lines that I put on here. We're positive across the board with the Keller market model. We're switching back to positive in the short term with commodities, still negative in the intermediate and long term, where the dollar is still negative on all time frames. And this is interesting. Real estate, utilities, staples. These are more the defensive areas that we've been watching. You could also put healthcare in there as well. It was up, but not up as much. Where we see tech, discretionary, and communication. These are the three big growth areas, and they did really well on Thursday. And so we saw an awful lot of positive things happening with the S&P setting an all-time high, the Dow setting an all-time high, crossing about 5,700, the NASDAQ just ticking off the different areas here, 4-year high, dollar setting a 52-week low, industrials and materials doing really well. So yeah, a lot of positive things happened. The only thing really negative was the dollar, and then we had the NASDAQ cross back down below 17.6 later in the day. Looking good here with the S&P versus the S&P equal weight. We were up a little bit with this ratio between the two, as the weighted index did slightly better than the equal weight. The Dow setting an all-time high here and looking positive with the Elder's Impulse system with the diamonds. Going up with the NASDAQ here and going up with the NASDAQ 100, but notice not setting all-time highs. And we're positive with the Elder's Impulse system for the Qs. We're positive with the NASDAQ 100 on a momentum basis. We're above the moving averages here with the Qs as well. Not breaking out, but small caps were up over 2%. Had a good day. The lines are going up. We're in an uptrend here. And we're positive with the Elder's Impulse system for the small caps. Here is another look at the Russell 2000 small caps. Starting to get extreme with the RSI. Looking good based on price, looking good based on momentum. Mid caps, not really breaking out yet, but up 1.72%. Positive with the Elder's Impulse system for the mid caps, setting an all-time high with the Wilshire, a broad market measure here. That's good. And we're setting an all-time high here with the total US stock ETF. That's also very good. And the staples to tech ratio really coming down, but we've seen a recent golden cross with this ratio, meaning that staples are now in an uptrend compared to tech. We want to see this continue to go down if we're more positive on the market. Financial sector up over 1%, still looking really good there. The FANG index had a nice little bounce, but not setting an all-time high. We're coming back up to this shorter term trend line. We've not closed above that, at least yet, where we did recapture the longer term trend line with the FANG index. NVIDIA was up almost 4%, coming back up to its 50-day moving average. Apple was up 3.71%, going above its 50-day. Meta, probably the best looking chart here, has been breaking out up almost 4%, and going up 1.5% almost was Google. But you see how this 50-day moving average is really coming down and getting above the 50-day moving average with Microsoft. It was up as well. Amazon was up solid, but also a declining moving average. Tesla breaking out above its 50-day moving average, up 7.33%. My goodness. And Netflix also up over 2%. And Amazon and Netflix kind of have the best looking charts right now. Comparing the US stocks to world stocks, seeing a bit of an improvement on the short term, we're still pretty strong in the longer term correlation. Oil was able to get back above 70. Even it went up on Thursday. The dollar was up a little bit, but we're still in a downtrend now. And we were up with the 10-year yield. We were down with the 10-year based on price. We're back to looking normal here with the 10 to the 2. And that seems to be hanging around. So I may drop this chart for a while just to avoid showing too many charts here. I already show enough as it is. We still have a ways to go here with the 10 to the 3-month yield curve. We're watching this too. See how the 3-month yield is just coming down with a vengeance here. And that's what happened back in 2007. But we have to look at the context. Right now, everything is looking good. Is that going to change? That's what really caused us to go down into 2008. And then we didn't bottom until 2009. And then we were flat for many years after that. Seeing not much of a real improvement here with growth of value. We ticked up with the Qs to S&P. Discretionary, you get Tesla up 7%. That's going to help. Discretionary to the S&P is looking probably about the best right now. And we turned up a little bit when we compare large cap growth to large cap value. So the large caps going up, mid caps going up, and small caps. But we need to see more follow through. This is a little bit of a concern too. The S&P to utilities ratio, it's not breaking out all that much. It's mainly because utilities have been stronger lately. And this is encouraging though. We're coming down with the Staples to S&P ratio. We want that to go down. And that means the S&P is outperforming. If this continues to go back up, that would be more negative for the S&P. And then here is the definition of the Hindenburg-Omen. Here is the chart where we have a confirmation now. 2 spikes within 20 trading days. And you can see back in 2020, this was right before the COVID crash. And this was the end of 2021 going into 2022. So that's why we pay attention to this. So what's our outlook? We're still positive for right now. We're concerned about our smart money indicators showing weakness. There is a confirmed Hindenburg omen. Doesn't seem to mean much right now. Maybe it'll come into play next week. And we do come into a period of really quite weak seasonality next week as well. It will be options expiration on Friday. We're not going to have any economic reports, and then all the different geopolitical things going on, whether it's pager gate or walkie-talkie gate, or is it going to be, what's the next gate going to be? Is something going to explode next? So no economic reports on Friday, and we're pretty much done with all the major reports of the week. Now, this is interesting. The S&P is only up 28.6% of the time on September 20th. Okay, and it's also options expiration. That's decidedly negative. Where we're neutral to negative with the Dow and the NASDAQ. This is options expiration where we are up 55% of the time, down 45%. But the thing to make note of, the week after can be quite negative. We're only up 30% of the time, which means, yeah, we're up 30% of the time. We can still go up. It's not 100%, but when you look at this on a statistical or a percentage type basis, yeah, it's some weak seasonality that we could see come into the market. And we're kind of ending this little happy time right now where we do see some weak seasonality going forward, a little bit of a pickup going into the end of the month. And Friday is the second most positive day of the week based on 2023. And it's also the second most positive day of the week so far in 2024. And this is the weak seasonality that I keep referring to. Another shot at seasonality looking weaker here. So the warning signs, and I feel like a broken record, but folks that watch this video, I want you to be aware, it's not all rainbows and sunshine all the time. There are some negative things that we need to respect, but we don't act on those things until we see confirmation in the charts. But for right now, there is a confirmed Hindenburg omen, but we're not seeing it in the short, intermediate, long-term versions of our charts. We'll just be waiting to see if it plays out that way, not declaring that something is going to happen. We wait for the evidence to tell us that that's what's happening. And we do have weak seasonality. The same thing there. Yeah, we might buck the trend here, but we could play into the trend as well. And we're keeping an eye on these defensive areas like staples, utilities, and healthcare. And the equity put call ratio based on 5 periods, it's now going up after being extreme negative. Growth to value, yeah, they're doing okay, but we need to see more follow through with this. And the positive signs, we have our 3 smart money indicators, which are all declining right now, even though they're positive. The equity put call ratio based on 10 periods is still going down. That's positive. The advanced decline line's looking really good. Our oscillators and Copic curve, they're looking pretty good. The S&P and NYC McClellan oscillators and summation indexes looking good. The Swenlin trading oscillator, it's flattening out based on price, but it's still positive, but it's going down based on volume. That's a concern to us. The parabolic SAR, though, it's either full-on positive or full-on negative. There's no in between with that one, but it's positive. And we're looking extreme with the bullish percent index for the S&P. We're close with the NASDAQ 100, still looking positive with the NYSE bullish percent index. The vortex is positive, but didn't really break out with the green line. The money flow, the ease of movement, ultimate oscillator is still looking positive there. Actually, the declining shouldn't be there. And the NASDAQ 100 is looking good on a momentum basis. Financial sector still looking good. So for right now, we're looking good, but there are some warning signs here. So our conclusion, we're positive, but we have this Hindenburg omen. We have weak seasonality, and the smart money indicators are declining, even though they are positive. In the short term, this is where we were watching for the smart money indicators to turn and actually lead over into price. Intermediate term, this is where the Hindenburg omen may play out and the weak seasonality as well. But we're still looking really good, but extreme with the long-term trend. Thank you. I really hope you found this helpful. Have a great day on Friday, and I will talk to you in the next video.